With your jobs report, here's Mike McKee. Morning, Mike.
Well, Chris Waller is going to be having a heart attack now. 92,000 jobs lost during the month. Last month's 130,000 revised down to 126,000. Not a major revision down, but a loss of 92,000 jobs. Now, there is certainly going to be some weather involved in that, and we'll check on that in just a second. The total payroll revision over 2 months is minus 69,000. So you got to add those two things together. Change in private payrolls down 86,000. Manufacturing payrolls down 12,000. Average hourly earnings up 0.4%, puts the year over year at 3.8%. That's a tick higher than it was. Average weekly hours 34.3, and the Labor Department says we'd see a decline in that probably if there was a weather effect. So it isn't clear that that is the case yet. And labor force participation drops to 62%. So some bad news on the labor front. Now, on the retail sales front, and these are January numbers delayed by the government shutdown, retail sales headlines dropped by 0.2, but ex-autos, they are flat. Weather may be an impact there. Control group up 0.3% after a flat reading in December. So a bit of an improvement, but not a huge jump in retail sales. So the numbers aren't particularly overall good this morning. I'll look at the further details for you and get back to you in just a minute.
Mike McKee, thank you, buddy. Looking forward to those details. Right now, the headline, bad news is bad news. Equity futures near session lows. We're down across the board on the S&P 500 at the moment, declining by 0.8%. Underperformance from the Russell, as you might expect. We're down by more than 1%. In the bond market, yields flip from being positive to negative. We're down at the front end of the curve by 3 or 4 basis points on a 2-year at 354. This is double bad because I'll tell you a market that isn't moving in response to this, and it's the commodity market. Brent and WTI still near session highs. Brent close to 89, WTI close to 86, and this is the problem for the Federal Reserve. This is what you don't want. You don't want to see downside surprises on the economic data and then see upside surprises when it comes to inflation. That is not what you want to see at all.
This is the worst case scenario of, and I'm dreading to saying this, but stagflationary shocks. Essentially, oil prices rising rapidly at a time where there doesn't seem to be that much strength in the underlying employment market. The good news is that January wasn't revised significantly lower, only 126,000 versus the 130,000 previously stated. The bad news is it's not just that there was a job destruction in the month of February, but that the unemployment rate rose to 4.4%, raising questions about how you can look through this if you're trying to come up with policy.
Does it go against the grain? Let's think about the data we've had so far. ISM has been pretty good now for a couple of months, both services and manufacturing. The data we've seen elsewhere, claims didn't scream weakness. Didn't see that in initial jobless claims this week or the week prior, for that matter. Does this data point go against the grain, given what we've seen?
Well, it certainly has gone against the sentiment that we've heard from a lot of investors and the reason why people had confidence in the strength of the U.S. economy. People might say, though, that the ISM services data hasn't really cohered with what we've seen in the labor market for quite a while and hasn't really been a good forward-looking indicator. Other people say, look, the responses to the survey, the job survey, have come down significantly. So can we count on this data in the same way? And then the pushback to that is it's the best we've got. So if this is the best we've got, what do you do with that as a policymaker, given a lot of conflicting data signals, given that other signs, the Beige Book included, say things are okay?
Let's go through the headlines then. The change in non-farm payrolls, negative 92,000 against an estimate of 55K. That's a big downside surprise on the payrolls report. The revisions, not great either. To Bramo's point, unemployment should anchor the conversation around how much slack is there? Is there greater slack, less slack? There's greater slack based on this. Unemployment rate coming in at 4.4%, previously 4.3%. The expectations was it would stay there. For more details, Mike, I want to bring you back into the conversation. Are there potential distortions? Does it go against the grain? What do the details tell you this morning?
Well, right now, it doesn't look like some of the outside influences we might have thought of had an influence. Only 228,000 people not at work because of weather. However, there is an impact on the strike side. There was a strike at Kaiser Health Insurance, 31,000 workers off the job, and we see a decline in health and social services assistance of 34,000 during the month. So there is a significant issue there. We also see that average weekly hours did not move. So along with the weather, that's the basic issue that we have. Construction jobs down 11,000. That might have been weather. We were expecting a rise. We saw a rise in ADP. There's been a rise in the last couple of months because of the AI constructions. Private service producing jobs overall, led by these healthcare numbers, down 61,000. Financial activity is one of the few that gained 10,000. And government down by 6,000. So it looks like some of the Doge firings have worked their way through the system right now.